Trading Market Technicals Morning Call video for Friday, February 1st. Non-farm payrolls are coming out at 8:30. Big number. Should be a market mover today. Mentioned on Wednesday that this non-farm payroll number is going to be a little bit more interesting than usual because the Fed had mentioned that they are tying QE to the unemployment rate and, of course, inflation. So that's going to be even more interesting to see what happens today. My guess is, and it's just an assumption of what I would think the reaction is. Remember, not the number, it's how the market reacts to the number is really what the trader and, of course, investor want, how they react to their portfolio. So I'm looking at this. A better than expected number would create the dollar to rise and put really some pressure on equities. So it'll be bearish equities and bullish dollar. Okay, so because of the fact that they fear that it's time the Fed to really hold in the reins and back away from their QE. And obviously the reason why this market is up at these levels is because of the Fed pumping in $84 billion a month in treasuries, providing liquidity to the markets. And that's exactly what it is. Yes, the economy is getting a little bit better, but it's going to take a long time before, and I mean long time, meaning it has been so far, and it's probably going to be another few more years before the economy really gets humming again. But now let's talk about a worse than expected number. So if the numbers are worse, then things could probably get even more interesting and see some real extreme levels here where then the dollar sells off and the market rallies and pops up, breaks above this high of 1509 in the S&P, the SPX, and then maybe take one more chug up to the old 1575 area. Now, that's just an assumption, nothing tradable, okay? Please keep that in mind. All right, so it's going to be really interesting to see what happens. I'm excited to see about 8:30 when 8:30 comes around. And we'll see where this market goes. I think this is going to be the mover that we're looking for. And even if the market does pop, I think it pops and possibly sells off. I can't see, just as a technician, a market technician, I just can't see the market continue to rally up, and at least without a break. But it can. You got to assume that markets can do whatever it wants, and you have to assume that it absolutely can. I think the numbers are priced in either way, so I think that at one point, whether it be today, Monday, or Tuesday, the market probably rolls over and does a little bit of a correction before they move up to the 1575. And I'll show you that in the charts and a reason why, what the charts are telling us, okay? So let's just roll right into a couple of things that I'm showing you. But we have the bullish percent SPX. As you know, we're extremely overbought from the whole month of January. Now we're back in here. We're starting to get a little bit of hook in the indicators. Again, indicators are lagging to price, but it does do its job telling you, hey, momentum is waning, use caution, right? Not that you're bearish, have to go sell the market as of yet, but we want to use caution, okay? Here's our NASDAQ record high percent index. We're starting to roll over. We've been at 100 the whole month of January. MACD starting to roll over, and as you can see here, very so slightly, but I'll show you in the charts, you'll see that we did break down from these channels, and you'll see the repetitive patterns, what I'm going to show you today. Here's the tick, and as you can see, every time the tick is elevated, we get a little bit of a sell-off. Here we are elevated, and now we're only here, don't keep in mind, we've only pulled back for 2 days, and Dow was down 49 points yesterday, and most of it was given up at the end of the day. Really, nothing was happening. Market really basically paused going into non-farm payrolls today. But as you can see here, every time we get elevated, we get a little bit of a sell-off here and here. So again, something to keep in mind. Tick highly elevated, and we want to use caution with that. NASI daily. Okay, NASDAQ summation index starting to roll here. Get a little bit of red, but again, that could easily touch and then roll right back up again. So we want to get confirmation that everything is starting to move on a bearish sentiment, right? We have bearish sentiment, we have bearish configuration, and we also have our indicators rolling over. Then you could say, okay, we look for a trigger, and then we look to short the market, which will, if this continues, we probably will be starting today or Monday. But again, we want to use caution, okay? Now, I wanted to show you one thing that we continue to watch. Watch this copper. Copper really leads the market. Now, copper broke out on Thursday and took a little pause right here at the resistance line. Now, Monday we go through a little bit of a longer-term picture and we'll show you weekly charts, but I want to show you the weekly chart of copper right now. As you can see, keep an eye out. You see how it's breaking out of this apex? It's right at the apex here. If this starts to break out, that doesn't mean that the equity markets will follow immediately. but this is going to be a very good sign. Like I said, remember the longer term picture still remains bullish, okay, as far as technicals are concerned. Okay, short term, way due for a pullback. Let's take a look at the VIX. As you can see here, we have traders, investors starting to buy some protection. And we made a little bit of low. We broke down, and we're back above the support line. So as you can see here, there is a little bit of fear creeping into the markets. We're at 14, still way, way, way low. But again, if markets do start to pull back and we get a little bit of volume, I wouldn't doubt the VIX get at least to 17. Look at the CBOE. And as you can see here, we're at 91%. We were down below 60-ish. It was a really extreme sentiment here. But remember one thing. Keep in mind, I wouldn't be listening to CNBC or Bloomberg. All they're looking for is to pump the market up. That's all they are, is bullish. And they don't give you a true picture. But you can see here we have some protection being bought here in the CBOE total put call ratio. So again, nothing really to be alarmed about, but we want to use caution because we still are at some highly bullish sentiment levels here. Now getting a little bit lightening up a little bit, but again we still want to just use caution because I do think that the markets are ready for some sort of a pullback. But again, non-farm payrolls could trump the charts. That's no question. Okay, so let's take a look at the Spiders Daily chart. Spiders Daily, you can see we've been in this grinding mode, trending higher in this steep uptrend channel. Yesterday, we actually broke down in the Spiders. And take a look at our indicators in that light blue circle. MACDs have not yet crossed over, but again, starting to look to hook lower to the signal line. And our stochastics are elevated here, can be elevated for quite some time, as we know, but we're starting to really now hook lower again, which if you looked at the whole pattern for the whole month of January, we really stayed above the signal line. And yesterday, we kind of broke lower. Again, early sign. I want to see some follow-through today. I'd like to see a follow-through day today, maybe a back test, and then start to really break down again. But again, you'll see what I'm talking about as far as the patterns are concerned. They're all the same, and they're all showing some bearish configuration here. Okay, take a look at our Spider 60-minute. Showed you the line here. We did break that line on Thursday. Okay, and now Friday is today, and we have the lower trend line here at 148.70. 148.70 on the closing basis would make this a bearish signal. And then we will look for the next sell setup as far as any kind of trade setup. Look at our stochastics, RSI, all breaking down and all turning lower. And this is on a 60-minute chart, okay? Now let's take a look at the S&P Daily. The S&P, the cash, has not broken down from its channel yet, but is there now. CCI just broke 100. So momentum is definitely waning, no question about it. We hit 5, I believe it was 509 from our 520 indication from inverted head and shoulders. Not bad for November inverted head and shoulders. I think we pulled this out, call this in December, early December sometime. So not too bad. Now we want to look and see what happens. We want to break lower, and we want our indicators to follow suit. Okay, now here's a 60-minute chart, and this is interesting. Here's what I want to show you. Now, if you remember, way back here, I had that inverted head and shoulders on a 60-minute as well, and that measured about 15.13 or so, 15.20 on the daily chart. And now we have this bearish rising wedge formation, right? Now, what I like to do is if I see this bearish rising wedge, and you can see here we're back in this area. I did put a fib count on here, Fibonacci retracement, excuse me, and right in here comes into about 1463, which is the 200 period moving average on the 60-minute. We do have our MACDs and RSI rolling lower. So if you take the mouth of the triangle and just stick it right up in here where price is, and then take this area here. Take one of these areas and put it right here. What do you get? You get the 50% right in that area. So this is actually what we would look for, and this is how I'm just trying to kind of forecast here. What I would look for the market to roll down in this bearish rising wedge would be somewhere around a 50% retracement area, which coincides to the 200 period moving average, a little bit up higher than that, and that will probably kind of pause as the market starts to roll down. But this is the real target area. So this would be the target, would be 1452, let's call it, for the target area, 1452. And we'll just put that right up in here. And this would really be your area right there. That's going to be the target area if the market decides to break lower and pull back. And that would be a decent little buy-in for one more push higher to test the highs. And then by that time, hopefully sometime around the spring, we will probably get our sell-off in the market and our decent correction. But we'll see. Let's take it one step at a time. But look, right here, break on this bearish rising wedge, 1454 is the area target I'm looking at. So you might want to write that down. Also, we have a 30-minute chart of the S&P cash. And here, on the small time frame, we have in a head and shoulders pattern, small head and shoulders pattern. Now, mind you, this is a 30-minute chart, so they tend to fail more than a higher time frame, 60-minute, and of course a daily chart. So 1483 is the measurement on this head and shoulders pattern on a 30-minute chart. So we do have some bearish patterns starting to set up. Now, this has not triggered yet. 1496 on a break and close would trigger this head and shoulders pattern, and this measured move would be from the head to the neckline, which comes out to 1483-ish. Okay, so that's that area here. So keep in mind now, we have some bearish patterns setting up. Take a look at our diamonds. Diamonds, again, had a big pop up and roll back down again. Now the diamonds, quite frankly, has been extremely strong thanks to the transportation sector. But as you can see here, the MACDs has not rolled over yet, and at least has not even touched a signal line, where the other sectors that we follow have either touched it or broke down, and so have the stochastics. So keep in mind, let's keep an eye on the diamonds. Take a look at the IYT, the transportation sector. This is the leader. This is the true leader of our sectors. And look what's happened here. Broke down and back tested. Now, a break below 102.34 would put me in a confirmation sell signal for the transportation sector. And that would also hinder on, of course, probably capping any type of short-term rally here if this tends to break down. So you might want to watch this, and that transportation, and this is the IYT. This is the ETF of the transportation sector. 102.34 is also my trigger. Take a look at our stochastics and MACDs rolling right over. As you can see here, this is actually really lagging the other sectors, and this is a leader. Take a look at our IWMs. Risk on. What we see here, we had a big pop back up again, but look what's happening. We're rolling over our indicators. Again, indicators are lagging the price. Price is king. Price is what pays us. However, we are lagging. So this here would probably a temporary push back up, back testing the lower trend line. A break and close below yesterday's low, again, would confirm that sell signal of risk off. Let me just show you one chart. This is the JNK. This is the Junk Bond Index, ETF, excuse me. And this is also a good measure of risk if you want to just quickly assess risk on, risk off. As you can see here, we have a bearish rising wedge, broke below. We have a 3-day sell-off. So risk is actually coming out of high-yielding junk bonds, right, and going into these safer haven sectors, like the healthcare, like the consumer staples, like utilities, like I showed you on Wednesday. So again, we have now we have some definite indications that the market may be rolling over and due for a correction. And it's good, it's healthy for a correction. But this is something that I don't want anybody to get caught up in and buying longs up here. I'd rather, if you're going to swing trade, maybe 1 or 2 days, keep your time frame short until we get a good correction. IWMs I showed you. Let's go to Apple, last couple charts. And here's a weekly chart of Apple. I just want to show you. We still have 1 day left. I'd like to see it today break above 477 if that's going to be the case. But Apple, to me, is just a trading stock right now. I would not be investing in Apple yet. I think it still goes lower before it goes up. Now, we could test this area here at 504. And if you want to take it for a trade, your stop's going to have to be at the low here. So you have a decent sized stop. But again, at least constructive. We're taking back at least 50% of that candle. I like to see it get above 467 today. 467, 470 on a closing basis on a weekly chart before I think it goes lower. And here's just the last few days. We have a couple of indecision candles, some doji candles here, just kind of stuck in a range. Head and shoulders pattern here when we call this thing up at 695, channel. We had another head and shoulders here, channel. And we have a small head and shoulders, which we call the 460 channel. So again, repetitive patterns are king here, remains the same. And this is what we want to see now. We want to see a break back up, at least try to fill the gap, and then I think it goes lower again. If you're looking to trade it, if you're looking for a longer term hold, I think I would wait for one more big flush. As you can see here, we had a flush here, but we didn't have volume. And I want to see the volume kick in. One more flush lower, and then I would start accumulating Apple. I wouldn't do it right now for the longer term, guys. Last is the Qs, sideways consolidation. It's not a bad thing. Could be a good thing as well. But as you can see here, stochastics have already rolled, and now is at 54%. MACD starting to break down lower. So maybe a little bit of test of this little area of support with our 50 and 200-day moving average. Break down lower here. You might want to look to start nibbling into technology. As of right now, it's being weighed down because of Apple. All right, guys. Caution today, 8:30 is non-farm payrolls. Let's see what happens. I'm looking forward to it. I'm very excited to see what kind of reaction we get. And that's going to really set the stage for the next few days, if not the next few weeks. So pay attention to non-farm payrolls. It's going to be a big number out. Be safe out there. If it's too wild, stay aside. Cash is king. You could always get in on Monday with a clean slate. Have a great day. Enjoy the weekend, and we'll have a big report out on Monday.